We all need to make smart decisions with our money. The Long-Term Investor Podcast shows you how by distilling complex financial matters into easily digestible lessons. And now, here's your host, Chief Investment Officer at PlanCorp and the author of Making Money Simple, Peter Lazaroff.
Happy New Year, everyone. Before I jump into listener questions, I have a few housekeeping items I want to put in front of you. The first is my 2022 Outlook contest. I've always wanted to do something like this with my followers, but I finally got my act together this year to make it happen. There's going to be a link at the top of the show notes at thelongterminvestor.com to a 13-question survey on a variety of economic, market, and political outcomes. I strongly suspect most people will feel like they have no idea what to guess, but that's okay. You can put as little or as much time into your guesses as you'd like. It's just supposed to be fun. But because I want people to participate, I'm going to give the winner a $500 Amazon gift card. So just head over to thelongterminvestor.com and click on the survey link in this episode's show notes. And this is episode 29. I'll be closing the survey at the end of January. And if I get enough submissions, maybe I'll do a follow-up episode on the range of estimates. One more thing before jumping into questions. I want to give a few thank yous out to those who have been really helpful in the early success of this show. First, a huge thank you to Kendra Wright, who does all my marketing work and coordination. There is absolutely no way I could publish a new podcast episode every week, not to mention all the other content I produce, without Kendra's effort and support. So thank you, Kendra. I'd also like to thank my producer, Matthew Passy of the Podcast Consultant. Matthew has helped me through the learning phase of podcasting, and I'll admit, class is still very much in session for me, but he is truly the best in the business. There's also a few content curators that I want to thank because they've been putting the show in front of more eyeballs, or I guess in front of more ears, or however you want to think about it. So thank you, Tadas Visconta of Abnormal Returns. He was actually a guest, so you can go and check out episode 27 for our conversation, and be sure to subscribe to his newsletter. I'll have a link to do that in the show notes. Another newsletter I definitely think is subscribe-worthy is Short Squeeze, and I want to thank them for sharing a few episodes of mine in 2021. This is one of the newsletters that I included in my blog post of favorite newsletters, which I'll be sure to link to in the show notes. And of course, I'll also give you a link to directly subscribe to Short Squeeze if you want to go check it out. A few more quick thank yous before diving in. Thank you to PlanCorp CEO Chris Kirchhoff for the support of my podcast launch. For those of you who don't know Chris, he fosters a very innovative spirit at PlanCorp, and I am incredibly fortunate that he continues to cheer me on as I expand the number of ways that I seek to educate and help the broader public. I also want to thank our Chief Compliance Officer, Mike Essen. He deserves a massive shout out because he listens to every single episode for compliance approval. And he also has to review all my other content, which if you subscribe to my newsletter or follow me on social media, you know it's quite a lot. So thank you, Mike, for all your hard work and also for the patience when I occasionally create a time crunch with some deadlines. And finally, I want to thank my wife, Anne, for her continued support of all my work. I've always had to work outside traditional office hours, but with the podcast, already there's been several times when I've needed to record or prepare for an episode at a less than ideal time. So obviously she has been a huge help, but generally speaking, nothing gives me more energy than her support and encouragement. So thank you, Anne, for being in my corner. Okay, let's dive into some questions. First one, there was an article in Barron's on the inevitability of a market downturn in January. Huge selling from capital gain postponement, frothy valuations, a decline in big tech, which makes up 25 to 30% of the S&P 500. One of the suggestions was buying puts. Is that a good strategy? Or is it better to sell some stocks ahead of a big decline? Thanks for the question. Here's the thing. It's one thing to employ option strategies when you have a significant single stock exposure, because that idiosyncratic risk isn't compensated. So there's merit in wanting to hedge it away. But I don't think options make sense for the long-term investor with a globally diversified portfolio. When you have broad market exposure, the risk and uncertainty you assume is compensated with higher long-term returns than what you'd earn in bonds or cash. Said another way, the risk and uncertainty you assume when investing broadly in the stock market is simply the cost of higher expected returns. You can't have equity returns without equity risk. Yes, it would be profitable to avoid the downturns, but that's not really possible to do without missing out on substantial parts of the up markets, which are disproportionately larger than down markets and last a disproportionately longer period of time. As a long-term investor, you must embrace losses. They are incredibly normal, and in fact, the S&P 500 averages a 10% loss about every 12 months, so any such pullback should always be expected. And historically, 20% drops happen about every 3.5 years, and 30% or greater drops about once a decade. When you really internalize the normalcy of losses, predictions of a stock market downturn simply just aren't that interesting. Rather than try to predict when the market will fall and make portfolio moves based on those predictions, a process that research conclusively shows is a bad approach, you should plan on losses occurring with a similar magnitude and frequency as they have in the past. This means having a mix of stocks and bonds that aligns with your ability and willingness to live through these inevitable downturns. That's literally the first thing we do when we're building out a financial plan. We stress test that financial plan across thousands of scenarios using different mixes of stocks and bonds to find the right mix. So I think that's really going to be the better approach than trying to use options to hedge some downturn for some reason, whatever it may be. I've had a few other questions related to investing at all-time highs, so I'm not going to read them all, but instead just share one quick thing about all-time highs. When you look at S&P 500 data, the returns in the 1, 3, and 5 years after a new market high are incredibly similar to the average returns for the index over any 1, 3, or 5-year period. So if you look at the 1,000 plus monthly closing levels between 1926 and 2020 for the S&P 500, 30% of monthly observations were new market highs. So they're pretty common. Now, after those highs, the average annualized compound returns ranged from 14% 1 year later after the high to just under 10% 5 years later. And if you just look at whether the S&P 500 rises or falls after it's at an all-time high, 82% of the time, it's higher 1 year later after reaching its all-time high. And 78% of the time, it's higher 5 years after the all-time high. I'll share a chart in the show notes recently published by Dimensional Fund Advisors that relays a lot of this information. But the short of it is that reaching a new market high doesn't mean the market is set for doom. Reaching record highs with some regularity is exactly what one should expect. Okay, next question. Would it make sense to sit in cash rather than bonds for a while? Is anybody doing this? I'm convinced that inflation is here to stay and that interest rates will be rising. What are you guys advising these days? So I had a couple inflation questions, and I'll address that part of the question more squarely in a moment. But first, I'm going to focus on the rising interest rates aspect. Episode 18 is a quick primer on what you need to know about bonds. If this listener's question is something that's on your mind, you should definitely check it out because it provides a lot of context to the interest rate environment we're in today. When interest rates rise, bond prices fall. And this is because existing bonds, when rates are rising, are now less valuable than the newer bonds that are issued at higher rates. If you own a portfolio of individual bonds, rising rates are particularly harmful as it's nearly impossible to have enough regular cash flow from a dozen or even 24 bonds to take advantage of higher rates. But rising rates are actually a good thing for bond funds owning hundreds, if not thousands of bonds. And that's because they are constantly receiving cash from interest and principal, which means they can quickly reinvest at higher rates to help boost long-term returns. For what it's worth, I personally think interest rates are going to rise in 2022. But that doesn't mean I'm altering portfolios to reflect that viewpoint. And I certainly don't like the idea of going to cash. While sitting in cash ensures that you won't experience any nominal losses, it also ensures that you will lose purchasing power over time. Also, you would have to make a decision at some point on when to get back into the bond market, and that really wouldn't be a straightforward decision either. That's the problem with any form of market timing, whether it's with stocks or with bonds. Look, risk and return are related. Bonds do occasionally lose money, but the good news is that their losses are far less severe than stock market losses. And if bonds do lose money, as they did pretty commonly in 2021, that doesn't mean they aren't doing their job within a portfolio. The primary role of bonds for a long-term investor is to reduce the overall volatility of the portfolio. Contrary to what many believe, the role of fixed income is not actually income, and it's certainly not supposed to be the driver of growth or returns within a portfolio either. The role of bonds in a portfolio is diversification and stability relative to stocks. So that's a really long way of saying, I don't see how going to cash helps anything. Again, my personal opinion is that interest rates are likely to rise in 2022, but that doesn't mean I'd move out of bonds. Next question. Should I be looking at TIPS or inflation-protected bonds? Now, this is actually me shortening many versions of this question. And one thing that's starting to bother me a little bit about people wanting to add inflation protection now is that the unexpected inflation has already happened. The cost of insuring against an event that is currently happening is naturally going to be higher than it would have been in advance. Now, I personally think about portfolio design using the well-founded idea that stocks are the best long-term hedge against inflation, and for most people, short-duration bonds offer enough of a hedge against short-term inflation to be sufficient. However, portfolios that are bond-dominant, so portfolios with at least 50% allocated to bonds, might have more need for an explicit inflation hedge. When it comes to TIPS, those are usually the most commonly discussed investment for those wanting to hedge inflation. But TIPS returns don't track inflation. They're actually driven by unexpected changes in inflation. So if you buy TIPS today, inflation needs to be higher than the market is expecting in order for it to pay off. And betting against the market is always going to be a dangerous proposition. Plus, TIPS are far more volatile than other investment-grade bonds, in large part because of their high duration, which means they are very sensitive to changes in interest rates. In my experience, people love TIPS on paper, but have a really hard time sticking with them due to the way they behave in real time. I definitely think TIPS have a place in hedging specific liabilities that are several years out. But I personally prefer stocks to hedge against inflation for future liabilities that are 5 years away or more. When it comes to explicitly hedging in a fixed income portfolio, though, I'm generally going to favor products that use CPI swaps to hedge inflation because they're far less volatile and they represent a more direct hedge to the liability those types of portfolios ought to be concerned about. You can listen to episode 8, which is titled Investing for Inflation, for more information on this one. Next question is somewhat related. With the yields on I bonds above 7%, why wouldn't someone invest their entire bond portfolio in something like this? Now, when this question came in, I really wanted to do a mailbag episode in December just because this question and the topic of I bonds were getting so much attention in the media and in the finance blogosphere. Here's the thing. So I bonds are government securities that pay a fixed rate and the inflation rate. So right now the fixed rate is 0%, but the inflation rate is 7.12%. So naturally you can understand why people might be interested in buying a government bond yielding 7.12%. The fixed rate and inflation rate, though, change every 6 months. So you shouldn't necessarily expect to earn this rate for more than 6 months. And I'll put a link in the show notes for details on just exactly how this rate is set in the historical rates so you can get a little idea of what it might look like. Because it's great to get a 7% rate on government security, But here are a few things to keep in mind with I bonds in particular. So first of all, you can only purchase $10,000 per person. Although you can get up to $5,000 of your tax return issued in paper I bonds that don't count toward the annual purchase limit. And I emphasize paper I bonds because the purchases happen directly through Treasury Direct. So if you're making a $10,000 purchase and you do it online, it's actually pretty easy. But if you had to take another $5,000 and it's a paper certificate, it's just one more thing you have to keep track of. And at the end of the day, it's very difficult to get a lot of money into these. So for a lot of people, you can't put your whole bond portfolio into I bonds, as the question asked. Another thing to keep in mind is that the rate is very unlikely to remain this high, and historically, the rate has been very low. So the link in the show notes that I'm providing, you will see that right there, but I just don't think that you can expect to earn 7% forever. If you could, yes, this would definitely be worth the hassle. One final thing to point out is that you can redeem these I bonds anytime after 12 months and receive the original purchase price plus interest earnings. But I bonds are meant to be longer term investments. So if you redeem an I bond within the first 5 years, you lose your last 3 months of interest. For example, if you redeem an I bond after 18 months, you're going to receive the first 15 months of interest, but that's it. The thing that you may have seen in the media leading up to the new year suggested that a married couple should buy $20,000 at the current rate in December and then buy another $20,000 in January, and then you could have a total of $40,000 in this type of security. My feeling is that if you want to buy I bonds, there really isn't much harm. Just be aware of the information I've shared and keep your expectations in check. Final question. I've been using a 2055 target date retirement fund in my 401k for several years now. I know it's cheap, but I was looking at performance and thinking it was a bit of a dog relative to what the market did in 2021. Should I be looking at other options? A lot of people these days have access to target date funds, which simply gives people a mix of stocks and bonds that the provider feels is appropriate based on the approximate year you plan to retire. Target date funds from Vanguard, Fidelity, and T. Rowe Price make up almost 90% of the overall target date universe, although there's many more providers than just that. But given that those three make up the vast majority, I'm going to assume this listener is using one of those funds, which gives me a lot of confidence in my response to this question. Most people use the S&P 500's return as their proxy for the market, and the S&P 500 was up 28.71% in 2021. So it was a really nice year, no doubt about it. But target date funds own more than just the S&P 500, which represents US large cap stocks. Target date funds own other parts of the equity market, such as mid caps, small caps, international, emerging markets, etc., all of which had lower returns than the S&P 500, which again just measures the performance of US large cap stocks. Now, of course, target date funds also have a bond allocation, which in many cases had a negative return in 2021 since interest rates were rising. The point here is that there's nothing wrong with your target date fund underperforming the S&P 500. There will undoubtedly be years where US large cap stocks are not the best performing asset class, and the target date fund's performance will look superior. That's all I have for today. I know I started the episode thanking a bunch of people who helped make this podcast possible, but somehow I forgot to thank you, the listeners. This has been a really great experience for me, and I want it to be a great one for you. So please leave me a review on Apple Podcasts or Spotify Podcasts. This helps me make the show better, and believe it or not, it also helps people find the show more easily. And don't forget to subscribe to the show so that you never miss an episode. As always, you can find show notes on thelongterminvestor.com and keep sending me these questions. I think these Q&As, these mailbag episodes are really great. Until next time, to long-term investing.
Thanks for listening to the Long-Term Investor Podcast. To access free financial resources and submit questions to be answered on the show, visit thelongterminvestor.com. Peter Lazaroff is an employee of PlanCorp and BrightPlan. All opinions expressed by Peter and any podcast guests are solely their own opinions and do not reflect the opinions of PlanCorp or BrightPlan. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of PlanCorp and BrightPlan may maintain positions in the securities discussed in this podcast.